Moving averages are at the heart of technical analysis, but the exponential moving average, or EMA, takes it a step further. In today's video, we'll dive deep into what EMA is, how it works, and why it's such a game changer for both beginners and pro traders. Remember, Trader Wall is like a free online university for traders. We teach everything from foundation to mastering. So, are you ready? Let's dive in. Introduction to EMA. The Exponential Moving Average, EMA, is a powerful tool in technical analysis designed to give more weight to recent price data. Unlike the simple moving average, SMA, which averages prices equally, EMA responds faster to current price movements, making it ideal for identifying trends and changes in market momentum. This precision and responsiveness have made EMA a favorite among traders in stocks, forex, and cryptocurrencies. How EMA is calculated. EMA uses a smoothing factor to determine how much weight is assigned to the most recent price data. The formula starts with the current closing price and adjusts it based on prior EMA values, with more weight given to recent prices. This calculation ensures that EMA reacts swiftly to price changes, unlike SMA, which lags more due to its equal weighting. Platforms like TradingView automate this process, but understanding the formula helps traders interpret EMA more effectively. Why traders use EMA? Traders rely on EMA for its ability to highlight market trends and signal potential price reversals. For instance, when the price stays consistently above the EMA, it often indicates a bullish trend, while prices below it suggest bearish momentum. EMA's responsiveness makes it particularly useful in volatile markets where quick decision-making is essential. Common EMA periods. The choice of EMA periods depends on trading style. Short-term traders often use a 9-day or 20-day EMA to track rapid price movements, while long-term traders prefer 50-day or 200-day EMAs to identify broader trends. Many traders combine multiple EMAs, such as a 20-day with a 50-day, to analyze both short-term momentum and long-term direction. EMA crossovers. Crossovers occur when two EMAs with different periods intersect, generating powerful trading signals. A golden cross happens when a shorter EMA crosses above a longer EMA, indicating potential upward momentum. Conversely, a death cross occurs when the shorter EMA crosses below the longer one, signaling possible bearish conditions. These crossovers are key tools for traders seeking clear entry and exit points. EMA in different markets. EMA adapts to various markets with ease. In stock trading, it helps identify trend continuations or reversals. In Forex, it tracks currency pair momentum, and in the crypto market, EMA is crucial for navigating high volatility. Its flexibility and responsiveness make it suitable for traders across all asset classes. EMA-compatible indicators. Combining EMA with other indicators amplifies its effectiveness. Pairing EMA with the RSI, Relative Strength Index, can confirm overbought or oversold conditions. Similarly, using EMA alongside MACD, Moving Average Convergence Divergence, enhances trend-following strategies. When integrated with Bollinger Bands, EMA provides additional insights into price direction and volatility. Advantages of EMA. EMA excels in capturing short-term price movements, making it ideal for day traders and scalpers. Its ability to filter out noise while maintaining responsiveness ensures traders can make timely decisions. In fast-moving markets like Forex and crypto, this precision is invaluable. That's the power of the Exponential Moving Average, a simple yet incredibly effective tool to sharpen your trading strategies. Whether you're analyzing stocks, Forex, or crypto, the EMA can help you stay ahead of market trends. If you found this video useful, don't forget to hit the like button and subscribe for more trading insights. And as always, if you have any questions or suggestions for future topics, drop them in the comments below. Thanks for watching, and happy trading!